Good morning, everyone. Welcome to the Fund Finance series. I'm Michael Mbayi, Head of Banking and Finance of the full-service Luxembourg law firm Praxio. So you know the formula of the series. I gather with experts in industry to discuss a specific topic. So the topic of today is 2024 recap and 2025 outlook. And to discuss this topic, we have a great panel today. So first, we have Frank Albano. Hi, Frank.
Hello, everybody. Frank Albano here from Catterton. We are a almost $40 billion private equity firm based out of Greenwich, Connecticut, but obviously offices all over the globe. Focusing primarily on private equity, but have recently jumped into private credit as well. I'm the global treasurer here, overseeing all of credit, cash, custody, and bank relationship management for the firm and funds. Look forward to discussing the very fascinating topic with you all today and my fellow panelists.
Thank you. And you have also Rossella Guanai. Hi, Rossella.
Hi, and thank you, Michael, for inviting me. I'm Rossella Guanai. I'm from UniCredit. UniCredit entered the fund financing business at the beginning of last year and has since then grown significantly. And I'm responsible for the desk. I'm very keen to be here today. Thank you.
Thank you, Rossella. And also Stan Likver. Hi, Stan.
Hey, Michael. Thanks for having me as well. Quick background, I'm at Ares Management in the Capital Solutions Group. I'm a managing director here, have been with the firm for almost 6 years and responsible for our fund level financing across the platform for all of our strategies, as well as our relationship management with respect to our lending partners.
Thank you, Stan. We have also Albertan. Hi, Albert.
Good morning, good afternoon, everyone, those of you in Europe. My name is Albert Tan, co-head of fund finance for Haynes and Boone. We are a team in our fund finance group, a team of about over 75 attorneys based in North America, Europe, and as well as Asia. And we primarily represent lenders in the fund finance space. And thank you for having me, Michael.
Our pleasure. And you have William Wallace. Hi, William.
Good morning and good afternoon, everybody. Thank you, Michael, and the panel for organizing this. William Wallace, I run origination execution for SMBC's fund finance platform. We're about a $60 billion business. We just got approval to go to $67 billion. So that'll start on April 1st. It's a global team, largely based out of New York, but colleagues in London, colleagues in Singapore, Japan, as well as Sydney. Looking forward to the conversation.
Thank you, William. And you have also Jan Wiese, Managing Director at Barings. Jan has some issue for connecting now, but he will come actually during the event and arrive. So as a kickoff, we can talk about the year 2024, which has been a particular year. And I would be interesting, Rossella, to know your views about last year and the activity of last year. Hey, Rossella, you're on mute.
Thank you, sorry. So I think a key theme remains liquidity and constraints in terms of liquidity, both at funds level and at banks level. Maybe I will touch a bit from a bank perspective, and I leave the colleagues who works at sponsor to discuss more the sponsor side of the picture. I guess in terms of banks, capital and availability of balance sheet remains a key constraints, and 2024 has been very much about identifying solutions to optimize balance sheet and free up space. This has developed in various ways. First one, rating significantly for European banks has become much more of a topic, with now all the rating agencies being active on rating facilities. This allows banks to ultimately have a better capital treatment for those transactions and be able to be more aggressive on pricings. Rating, which initially was pushed back, significantly public rating by sponsor, is now becoming much more accepted as a private, but also with several landmark transactions achieving a public rating very visibly in the market. A second theme about freeing up capital is the use of securitization and the risk transfer to free up space on the balance sheet and distribute exposure to capital call facilities, in particular to non-bank lenders and investors. This started in 2023. In 2024, we are seeing this ramping up. And again, this is somewhat connected to the rating topic, as rating the underlying facilities allows better capital treatment of the securitization, which have those facilities as collateral. Another theme is syndications. I think we see much more large players in the space competing to be the agent bank, having a significant role as an initial lender in the facility, but then reaching out to a broader space of banks for syndications. We are seeing some new lenders coming in the space as it becomes larger. One of those is also UniCredit, which started providing fund financing at the beginning of last year.
Thanks very much, Rossella. And William, from your side, what do you see?
Yeah, I think a lot of those themes that Rossella had mentioned are very prevalent. We're kind of on a little bit of a different trajectory, having done this business for almost 3 decades now. But a lot of the themes still hold true, right? Trying to manage your own internal balance sheet via ratings, which unfortunately for us is not something we utilize due to regulatory constraints from the Japanese regulator requiring the rating to be public. So that certainly hamstrung us a little bit from using the ratings criteria to get RWA treatments. But certainly the credit risk transfer transactions are heating up, and certainly something that we think we will explore probably in Q2 of this year as we brought over a team from Morgan Stanley to help execute on those. One other thing I think that's important, right, is just the general pricing environment, right? You saw the margins explode during the regional bank crisis and certainly through that latter half of 23, and they kind of moderated a little bit in 24, and in the early parts of this year, they're creeping in, right? So I think on the wide end, you might still see stuff sparingly getting done with a 220 kind of marker, but the leading players out there, including Stan and Ian on the call, are pushing down south of 200, maybe even 10, 15, 20 basis points south of there, certainly on bilateral transactions. So I think that's a big component that we've seen shift, right, where you had a period of time when a lot of lenders had exited the space because of concerns around their funding requirements and the general return metrics on it. And they've all come back in full force as they've realized the benefit of the business to their platforms. Not to mention that the new year has begun for most lenders in the space in January, and they're eager to put capital to work. They've been on the sidelines potentially for a little bit, or they just have a fresh slate of capital and they're looking to meet their budget as soon as possible, right? So there is a lot of competitiveness in the market today, which is healthy, right? Obviously accrues to the benefit of all the GPs in the space. But being honest, if you think about the risk underlying, still being really strong LP, the most side of it, right? Obviously, we're just talking about the subscription in that space. If you're talking NAV or hybrids and other types of transactions, it's different. But that inherent risk has been pretty stable. So due to the lack of liquidity in the market, the margins gapped out for a period of time, but they've come back to some semblance of normalcy, right? So we'll see how much that creeps down throughout this year. But I'll pause there, Michael.
Thank you, William. And Albert, from your side, what do you see?
Yeah, so for 2024, what's interesting is I would say that thinking back the beginning of 2024, I think my general feeling and just observation looking at our data, it was, I would say the first quarter was mild relative to the previous years. But then I think true to form, as we speak to our clients in the lending space, they were projecting that activity would pick up starting basically end of Q2 and start of Q3. And it kind of bear out exactly like that. I think we may have the activity started really picking up towards kind of the mid part of Q2. And I think the momentum really carried itself through the balance of Q3 and Q4. So statistically, kind of from a volume of transaction perspective, what we saw towards the end of the year 2024 was that the volume activity comparing to our data of 2023 deals from our clients, we had almost a 20% activity increase. So I think that was something that was particularly interesting from our perspective. And the other point that I think William did bring up was we started to see the pricing compress towards the basically, I think Q3, Q4 at the pricing starting to compress, the compressing trend. And then we also saw lenders trickling back into the space, new entrants, and the continued evolution of lenders being more creative with what they're offering in terms of their product, and just different structuring that they're willing to accommodate on a bilateral basis. But overall, the fund finance market 2024, I think was I think still grew in the sense of just overall market activity wise, at least from our perspective. And I think it generated a lot of momentum heading into the beginning of 2025.
Michael, if I might interject one thing, and it might be a decent pivot for Frank and Stan and Ian to hop on. One question I have, I think it may have been more of an observation, but something I think is interesting was during the crisis of 23, we saw a lot of lenders certainly shrink their requests. So instead of asking for 200 million, maybe they only asked for 100 million because the price was incredibly expensive to what they were accustomed to. And then towards the end of 23, and certainly for about the first 3 quarters, maybe the first half of 24, they seemed to take a larger portion of the facility down, realizing that the capacity wasn't there. So if they could get the capacity, they took it, even though they might not want to utilize every last piece of it. That has certainly moderated a bit to where the latter half of 24, at least from my perspective, GPs seem to understand a little bit more of what they would need in running through their models, understanding the cost of the financing as a whole. I'm curious from the GPs on the panel whether that was a consideration. Did you just take what you could get, even though it was going to be expensive in the beginning of the crisis, the late 23, 24, then say, okay, I'm just gonna get as much as I can because the capital is scarce for a portion of 24, and then kind of moderate that a little bit? Just curious, you guys.
Yeah, I could comment on my side at least that it was probably a blend of both, right? I think there was instances where we had exposure to banks that we felt were quote unquote risky coming out of the crisis and said, hey, we need to pivot fast and doesn't matter pricing, we need availability to us right away. Also couple that with, I think we needed some sizability, right? Like I think there was some deals where we needed something that we had high conviction. If it was a party that we felt could provide a large ticket to us, that can also operate in a manner that's quite flexible. Let's jump on that, right? So I think it was a fund by fund, strategy by strategy specific decision, but both were factors in play, especially coming out of that time frame.
Yeah, maybe I could piggyback off of that. I think I agree, with Frank. I think it was certainly an important element in sort of decision making around how to best size our facility needs. And reality is, generally speaking, from a fund financing perspective, Ares tends to be, conservative regardless sort of the environment. And so never really looking for outsized capacity on average. Again, it sort of is strategy dependent. I think broadly, again, speaking within the 2024 timeline, we were sort of fortunate to have reliable partners to sort of continue to meet our capacity needs. And so I wouldn't say we really kind of changed sizing from that perspective. I think if we looked at 2023 or even dislocations in 2020, in those sort of environments, from an asset sort of leverage perspective, in those cases, we would definitely be focused on kind of shoring up liquidity and ensuring we have the capacity that we need. But again, sort of 2024 specifically, I feel like the year there started cautiously optimistic. Everybody was coming off of 2023. That felt like it was getting digested relatively well by that point in sort of the early part of 24. Still a little bit of price discovery, as everybody knows, that everything was sort of elevated in the context of economics and even in certain cases structures. But there was sort of a sentiment that deployment was going to come back, and in agreement with Rossella and what William said earlier, we did see quite a few banks that maybe were on pause or sort of slowing things down in 23, re-entering the space. But then even beyond that, all the innovation that was mentioned, in Rosella's points, that I think was really, from my perspective, and again my personal opinion, was kind of it was sort of the defining factor of 2024 with respect to ratings methodology, with respect to SRT trades that were getting done, freeing up capacity, with respect to non sort of traditional lenders coming into the space, whether it's sort of setting up forward flow securitization structures to sort of relieve banks on their capacity needs and allow them to sort of originate more and do more. But at the same time, that sentiment of deployment or the optimism around deployment, I don't believe it materialized as much from sort of the manager's side of things, just on average. And so with that kind of opened somewhat, I wouldn't say the floodgates, but allowed the market to continue to sort of tighten up, as we did see, I think, meaningfully by the end of last year. And then now at the turn of this year, as William said, we're definitely seeing that continued sort of pricing pressure. So that was kind of the 24 recap from my perspective, and then also the view on how we maybe adjusted our considerations around sizing and such.
And I think just quickly, Michael, just come piggybacking off what Stan mentioned, on the back end of 24, I think some of the banks that are coming into play, especially, are looking to kind of get exposure, at least to us, and I'm sure to others out there. I think any facilities that are coming up in renewal in 25 or things that are kind of 2-3 year deals that we had in place, I think are going to create more of a competitive environment, and maybe a little bit, I don't know if the others on the call are going to love this, but I think a little bit of sponsor friendly terms that are going to be out there, just because I think where the cycle is now, we were probably on the worse off, and now are going to probably be better off, just given where we are within that cycle.
If I may just on this one last point, and Mike, I'm sure you probably want to move on. One of the things that I thought it was interesting is, we all recognize that North America is the most stable and the largest fund finance market, followed by Europe and Asia. And then the economics of the different regions, there are differences. And one of the things that I notice is the exploration some fund sponsors, particularly the larger fund sponsors with their strategies, might be arbitraging how they're looking at, hey, perhaps I can refinance my facility coming up for renewal with lenders that are in, say, in a different region that are accustomed to a different price point than perhaps in North America. So we started to see some of that, where some of perhaps a regional focused fund for a global sponsor looking to basically refinance out of the kind of a more expensive region and taking advantage of a region that is offering more competitive pricing. So that's kind of an interesting development that we started to see towards the end of 2024.
Thank you, Albert. And Ian, I think that you are there. Maybe you can give as well your perspective from your side for 2024. Ian, we cannot hear you. I don't know if you're from your side, you can hear us. Maybe you're on mute, Ian. You can try to. Yes, no, you're not on mute. Maybe you can try to speak. Let's see if that works. No, that does not work. Yes, we're on a digital age, I would say, that kinds of thing happen. So we need to adapt with this. Maybe Frank, you have further views on 2024 to add?
On my side?
Yeah.
I don't think there's much else to add for 2024. I think Stan and I, kind of touched on, I think 2025 is going to be what I would say is a pivotal year for the sponsor in terms of kind of reshaping what the outlook is in terms of bank relationship, what the outlook is in terms of, I'd say new vintages or kind of things that are coming down the pipe that we can start to think about and plan accordingly. The biggest thing for us, as I mentioned, is just, I think we're trying to try and take advantage of the cycle that we're in terms of where we are with bank pricing, with kind of relationship building. And as kind of Albert touched on, obviously, we are a global firm and have strategies all over the place. So really kind of leaning into where we think we're going to get the most value, dependent on region and dependent on institution that we're dealing with. We do a ton with a number of banks out there and have, different types of exposure to them, both not just on fund finance, but whether it be in derivatives and hedging or cash management and all. So really kind of looking at how do these institutions interlay with our whole organization? And I think that is going to be a key focus of ours going into 2025, especially as we think about renewals and new facilities and new funds that are being launched going forward.
Thank you, Frank. And Stan, for 2024, have you still some words to add?
No, I think my previous comments around 24 sort of cover that off. But again, to echo William and Frank with respect to 2025, I think the sentiment continues to be optimistic, and that was one that, as Albert sort of mentioned, definitely started in Q4 with the meaningful, I think, increase in deployment, and also ultimately leading to sort of tightening up of spreads on the economic side of things. And so we kind of continue to see that. I think, selfishly from my side of the table, that's a positive, and so that kind of probably shifts the balance a little bit from what we had to, Frank and I probably had to undergo in 23. And so I think it's a pretty exciting sort of time in the year. Certainly gearing up for fund finance in Miami, which oftentimes after that conference, folks come back reinvigorated, and then sort of, I think a lot of deal activity ends up picking up post that. So that's kind of the way that I'm thinking about it sitting here today.
Thank you very much, Stan. And Albert, for 2025, what is your outlook? What do you see on your crystal ball?
Well, from our perspective, I think the start of 2025 is in a way significantly more positive compared to the mood of beginning of 2024. I think number of our clients, as I mentioned, towards the Q4, the momentum has certainly carried forward to January 2025, and I think looking at kind of our clients' activities, 2025 has gotten off to a super fast start. So if that trend if January 2025 activity level wise that we're seeing from our client continues on, then 2025 could be a very positive year for many of our lending clients and also for the fund sponsors. It just seems like there's a lot of activity of new transactions as well as renewals that are, if you think about, number of facilities are structured with 1 year, 10 years, and uncommitted extensions and so forth, and all of that is coming back. And so our anticipation is if the momentum carries forward, then it's going to be a very positive 2025.
Thank you, Albert. And Stan, in terms of outlook for 2025, what do you see?
Sorry, was that for me?
Yes, indeed. Your
outlook for 25. Again, I think it is certainly sort of a positive environment at the moment. I think folks are sort of waiting to feel out the sentiment at the FFA conference. It feels like that's always a little bit of the of sort of the start of the year sort of tone setter. But with respect to that, I think it's going to be continued innovation as we saw in 24. With sort of non-traditional lenders continuing to push into the space, just given the amount of dollars raised specifically for fund finance opportunities. I think the fundraising environment for managers continues to be active. I think 24, certainly from Ares' perspective, was another record year for us. I do think it'll kind of depend on strategy and sort of business vertical. So, I think we've seen kind of real assets and real estate come back over the course of last year versus, the challenges of 23 and maybe even a little bit before that. And then, when you think about private credit and sort of secondary strategies, that remains, quite strong from my perspective, at least. And so with that and the continued sort of capacity in the market, I do believe, William's mention of 10 to 20 bips south of 200, I think we'll definitely continue to see that tightening. I don't know exactly, definitely no crystal ball here, but not sure where ultimately pricing lands, but do believe, it to be a borrower sort of friendly environment throughout 2025, subject to, any unknown that we'll have to handle if and when it comes.
Yeah, just following on Stan's comments there, I think for us, there was a lot of refinancings in 2024, right? The portfolio we run is very significant. So naturally, there's going to be a lot of extensions. But I would say from November till now, there's been far more activity on new fund launches, right? Where you're coming in to pitch for a brand new deal. We're not winning them all for sure, but echoing Albert's comments, right there was a real push in January. So it feels like there's some nice green shoots, right? We keep hearing in the market of this friendly U.S. regulatory and governmental environment, hopefully opening up the M&A and IPO market. Obviously, the interest rate environment is different than it was last year. So I think there's a lot of different strategies that are going to be able to take advantage of that. And they seem to be coming to the market at the right time where they're having their first closes and looking for fund financing. And it seems to be set up pretty nicely for a lot of activity this year. I I think one thing to point out that I liked Stan's comment on, that I hope, because it's something certainly we as an organization try and do, is have some more innovation in the market, right? We've done and are looking at a second acquisition financing that has a subscription wrapper to it. There's different types of secondaries transactions. Welcome, Ian, good to see you. That are ongoing, that are different, using fund finance technology outside of just a standard commingled strategy is something that I hope we as an industry can lean into more and more this year. We don't need to put, tens of billions of dollars to work into it, but I'd like us to evolve or continue to evolve into that space of using the technology in a different and more solutions-oriented manner, which I think benefits everybody. Not only are they more, they're interesting and thoughtful to work on, but it helps expand the business from its current state to something different in the future.
Thank you very much, Jan. And from your side for 2024.
25? Yes. Listen, I think 2025 is going to be, for us, as I mentioned, kind of a pivotal year for a lot of our deal pricing. But I think one thing that I haven't mentioned, but I do think will be key, and is I think William exactly just touched on it, and I know we're going to talk about it in a little while, is around fundraising, right? I think there's a lot of nuances to what has occurred in terms of bringing capital in the door that maybe shift what the traditional, LP kind of subscription has looked like. We've had some kind of what I would say is bespoke structures that have kind of come into play that we hadn't seen historically, right? And so finding a right bank and lender that can be flexible and nimble and constructive around that is going to be important, right? I don't think, the day and ages of a first and final closed or, a one and done, traditional LP base, I don't think it may come back, but I think at least in the near term, you're going to get a lot more of these kind of creative fund level structuring and structures that are being contemplated as we onboard new funds that are just not the cookie cutter, clear cut approach that we've had historically. And so finding the right party to be thoughtful and constructive and willing to work with you on those is going to be important, I think.
Thank you very much, Frank. And welcome back, Jan. So Jan is there. So he's managing director at Barings. Maybe you can introduce yourself first, Jan.
Yeah, apologies everybody for being late. So yeah, I'm a managing director at Barings portfolio finance team. We've deployed about $48 billion into the portfolio finance, fund finance strategy. But maybe just carrying on what William and Frank have said in terms of kind of themes for 2025. I think if we take one step back, just the market itself, liquidity remains a key focus for many funds. And we are seeing that whether it's on the secondary side through a programmatic dividend recaps at fund level where LPs are getting money back more programmatically. We are seeing through fundraising tools, if we speak about CFOs as an example, really the rated notes being an attractive investment proposition for insurers and others. And that's allowing in a
We have still some
technical
issues, but that's fine. And Rossella, from your side, then, if you can add a word for 2025.
And I'm not sure if my
and I think that it was frozen for a point, and I don't know, maybe a question of connection from your side. but Rossella suggests that you go ahead.
Sure. So I echo really what the colleagues in the panel said. So we are already in 2025, which is proving more borrower friendly, with transactions which had been executed just 6 to 12 months ago, repricing tighter. We're seeing fundraising picking up, probably with a bit of a divergence in fundraising, with very successful funds who are achieving much even beyond their original target in shorter timeline. This is true especially for the very large funds, with probably mid-size fund really struggling and going beyond their targeting timeline and not achieving the initial target set. I can see a bit what Frank also was saying about also different sources of liquidities for GPs. So with secondaries being very successful, with looking at non-institutional pockets of liquidity for LPs, or in particular targeting more aggressively very wealthy individual and wealth clients as LPs, and also those type of LPs now becoming part of the borrowing base in some of the facilities. Historically, those were more zero advance rate type of investor, more and more either via organized feeder funds or individually they are being recognized some value. So I think I definitely agree with the positive tone, but let's see what we will say when we look back at this video 1 year from now.
Rossella, one quick question for you from a European vantage point. Do any of the GPs that you're interacting with, or frankly even your own credit department or senior management internally at UniCredit, are they talking about the disruption or the change of tone coming out of America, largely from the new administration? How much is that a point of discussion?
It is very much from Davos a couple of weeks ago. It's a theme. It's, to be honest, it's seen as an healthy challenge. This is in general an healthy challenge for Europe in general, and I think it's triggering a conversation at all levels, from a political level, from a bank sector level, from an individual banks and businesses perspective, and I really see a positive tone to that. Ultimately, we're seeing a very much pro-business environment in the US, and in a way or another, Europe needs to react to that.
Michael, I'm curious from your perspective on
I think likewise. I think like
in European law, how much does it affect?
I think likewise. So because in Europe you have the European Commission, so the idea to have some regulation and to have some view about how you do business. But then if you're at the other part of the ocean, the government has other view and there is less regulation and so on. You're also obliged from your European perspective to adapt. And one example was yesterday. So the announcement of it's putting in hold of the regulation about artificial intelligence, AI. So there was in preparation European regulation about this, but since there is a direction in the US, there is obviously as well a direction and decision to be taken in Europe. So there is definitely impact what we do. I think that, for instance, capital reliefs and so on, what will be the position in the coming months and so on. So if there are different positions in the US, what would be the position in Europe? So this may impact SRTs or CRTs and so on. So yes, it should be interesting to see the evolution of all this. So what will be the final position in the US, and or in Europe will react vis-a-vis this, and if there will be less regulation or still some regulation to maintain, I would say, some European view on this. So yes, interesting times, I would say. And William, from your side, do you have something to add for 2025?
No, I think we covered it. I'm really interested to see the regulatory environment, how it shapes investing themes. I'm curious to see if we get more innovation in the space. I'm curious to see if the CRT platforms and more institutions get used to them and use them more frequently. One of the big wild cards that we've talked about is the non-bank lender space, right, and how prolific they become. And the question becomes, as margins decrease, is that still a viable investment strategy for them? I think you're getting down to where it might be more of a cash plus type of product. And certainly the sexiness of the higher returns is losing momentum, but I think they're here to stay, right? And GPs are positioning themselves, certainly having term loan tranches and deals where necessary to accommodate some of their internal LPs and as well as external providers that are looking for that term loan piece. The bigger question, I think, is going to be how many of those non-bank lenders can take a revolver and comply with the needs of a GP from a revolving standpoint. I think that will be a complete game changer when non-bank lenders figure that out in a more efficient manner. That opens up a monster wall of capital. I don't think that's this year, but I think it's coming. So I think we're on the precipice of a lot of change in the sector. Not to mention the NAV space, right, which we rarely haven't touched on this call, which is just getting going, right? I appreciate it's been around for decades, but in different shapes and forms. But you're seeing far more lenders get comfortable with the structures, be it primary deals, be it secondaries. The latter's obviously been around for a long time, but primary getting more and more traction. Again, with banks and with non-banks. So there's a lot of expansion and changes to come. And I think this year is going to be a pretty big pivotal moment for that.
Thank you, Will. And Rossella, as you are there, it will be quite interesting to know more about the private equity market in Italy. So I think that Italy and Spain in Europe have been, two jurisdictions which are performing in terms of business. So yes, I would be interested to have your views on this.
Yeah, sure. So in terms of private equity outlook, Italy is the fourth largest market in Europe after the UK, France, and Germany. And last year it was a very busy year with a lot of growth over the previous one. There were a total investment of about 50 billion in terms of private equity investment transactions, and private funds were accounting for about half of the overall M&A deals in Italy. Focus was in particular on the retail and luxury sector. I guess we have here Frank Catterton was very visible with the acquisition of Kiko Makeup, and it was one of the largest deals in Italy last year. I guess in terms of the Italian fund financing business itself, that remains focused really on Italian funds with primarily Italian players and some European banks which have a strong Italian presence active. In terms of structure, it's fairly in line with the Luxembourg one, let's say, with a security package and the pledge on the claims as well as a pledge on the bank accounts. I guess one thing to be very careful is because the Italian market is not yet so developed. One particular aspect to be careful about is the LPA agreement to ensure that this allows the fund to enter into those type of facilities, as well as allowing the lenders to submit the drawdown notice to the investors. One other thing is that often Italian funds can have restriction on disclosing the side letters, so often this is we get around by having reps.
Thank you very much, Rossella. And to the audience, do not hesitate to send your questions during the event. We'll take up, yes, during the event. Do you have at the bottom right questions button? You just can add your question there. And Frank, in terms of fundraising trends, what do you see?
Yeah, I mean, listen, I think, it's definitely a tougher environment than it's been historically. There's a bunch of factors that I think everybody on the call, both the panelists and the ones in the audience, have probably great understanding of, right? That I won't bore anybody with the details, but I think what we've noticed is because it is not the easiest environment, because of the multitude of factors that play into that, we are trying to get creative with how we bring capital in the door. Rossella brought it up earlier. There's more private net worth individuals that are coming into this space than have ever before been there, right? And making up a larger kind of quantum than we've ever seen historically. So with all that being said, is we're tapping into different pools of capital. Where I would say structurally looking at different ways to bring capital in, right? As we talked about, there's the rated feeders and the various numbers of different structures that are bringing capital, especially insurance capital or the like, that's coming in a various number of ways. So we have to adapt to that and move away from like I said before, the cookie cutter. Just sign an LP up to a standard subscription, call it 2 and 20 and walk out the door and that's it. Those things are not as straightforward as they used to be. And I think from my perspective, it's a good thing, because I do think it does make us more creative in how we think about, fundraising as a firm. But B, I think it also helps us tap into pools of capital that will probably transform as time goes on in terms of how they deploy allocation towards private equity and private credit. And I think that is going to be a key, we're at a key point for that. And I think is exciting for us, albeit tougher than what it's been historically.
Thank you, Frank. And Stan, do you have something to add on this?
Yeah, no, I mean, I agree with Frank, certainly with respect to I don't think this is new for 25, but it's sort of the continuation and the expansion of sort of more structured thinking around fundraising. And so with that, I think also that'll translate to sort of the fund financing world in exactly what Frank said, is the importance of lending partners to be constructive and thoughtful and also creative. And again, back to innovation, to be able to provide sort of, borrowing base credit or sort of advances against whether it's rated note feeders, private back notes, and sort of any other type of kind of structured equity that's coming into the funds, as managers continue to be creative, but also continue to try to broaden the net of investors that they could bring into their various strategies. I think also, aside from sort of structured commitments, from a fundraising perspective, agree with Rossella, in a very big way, is to sort of further broaden the scope of investors. We're seeing, at Ares, but also across peers and others, the focus on retail investors. And so that's going to feed into William's point around NAV, in that those structures and those new products are actually coming in different wrappers, but certainly in sort of perpetual vehicles, retail funds where they're effectively paid in capital. So no real uncalled capital to sort of do your plain vanilla subscription facility. And so that's going to require, and we're seeing it, and I think that'll continue to grow as that pocket of capital sort of grows in the NAV space, and sort of requiring NAV financing structures for those products. So that's going to proliferate, I think, no question, through 25 and beyond that. And then the other thing, just with respect to fundraising, just kind of broader comment, I think it will be very strategy dependent on sort of the success and activeness, if that's a word, within the different sort of business verticals. So I think if you take a look at private equity, I think everyone continues to be excited, as they were last year, on sort of M&A coming back and sort of deployment there. I think that remains to be seen. It feels like this first quarter hasn't probably been as active as people thought it might be. Obviously, there's backdrops, whether they're geopolitical or other, that are potentially impeding those types of opportunities. But then if you look at things like secondaries, I think that remains a super strategic area for our firm and I think others. And with respect to sort of credit secondaries, that is probably less developed relative to maybe a private equity secondaries. So I think we'll continue to see kind of growth there and appetite and interest as the market gets better educated, but also more active on the asset side of things, as an example.
Stan, I'm curious, how have and I appreciate it's not your day-to-day focus, but how excited are the marketing and fundraising teams about the democratization vehicles where you're looking at more of a retail instead of a high net worth or an ultra high net worth or institutional LP segment? Do they feel as though we're sort of at the tip of the iceberg and there's a really big market here to enjoy from a distribution perspective, or not? I'm curious if there's a house view on it or something.
Yeah, so I don't know that I can't speak on a house view or sort of for our sort of marketing folks, but I could speak sort of from my perspective and my opinion on sort of the landscape there. And I think generally, again, there is a lot of focus and excitement from just kind of what I'm seeing and hearing, whether it's at our firm or others. And I think it's kind of been kind of well documented in the market and sort of in certain articles across Bloomberg, et cetera, in that is a pretty big untapped market still. I think when you consider, folks like our firm that has been pretty active in things like BDCs that are already very much retail focused products in a slightly different manner. But still, nevertheless, kind of the infrastructure at managers that's been built with respect to that, I think is going to be important to sort of leverage and then effectively roll out other products. And so when you think about things like our APMF fund, which is our private markets fund, effectively private equity secondaries, geared towards retail distribution, I think that's an innovation ultimately in the market. And, we've got others sort of coming with that regard. And so that's going to continue to be an important focus to sort of expand, AUM. Obviously, fundraising is kind of the name of the game. And so, I think it's going to be in all of the above, and it's not going to necessarily sort of diminish the importance of institutional fundraising. But as that has kind of, come to, again, my perspective, a more mature sort of point, you kind of got to go and find, capital elsewhere. And so I think retail is going to continue to be important and a real growth area for a lot of managers.
If I could just jump in quick on that too, I think, William, one of the things that's probably worth highlighting as well is I think there's an education too that needs to happen to the market a little bit more, especially in that. Mm-hmm. So I think it's prevalent. I think, we're getting a lot of interest from a lot of, feeder vehicles that are saying, yeah, we want you to tap the retail market. But when you get into it, I think there's still a level of uncertainty and unknown from those parties that they need to wrap their heads around, the PE model or the private credit model. And I think as that education starts to continue and go forward, you'll start to see more and more of a ramp. And I'd say more and more of a, I don't know if more and more of a formalized approach to these, where it's kind of like, if you take your kind of traditional institutional, they've had an allocation to that they know they're going to fill, just depends on what firm they're going to put it behind. I think, these feeders will probably be in a similar boat in a few years where they're going to say, all right, I've got, X billion of dollars that I'm going to put, and I know I'm going to deploy it all this year. I think there's we want to deploy this much, but we don't know how to do it or where we want to put it yet. So I think it's still a little new, but I think the excitement is there. I think there's really a lot of momentum behind it. And I think there's certain products, as Stan mentioned, where I think people know and are supported, but I still think there's some that are still being learned of and moving forward on.
Yeah, that's fair.
Michael, and again, as that education process sort of takes place, which I think folks are investing quite a bit on that sort of broad market education, that'll, drive, I think, that type of capital raise.
Yeah.
Michael, if I may, I just on the theme of fundraising, we have some global funds here, and then William global coverage for a larger national bank. The trend in fundraising has been that while the dollar raise may have been slower than perhaps at its peak maybe a few years ago, the dollar raised by, frankly, it's at the same level compared to, say, a couple of years ago, but the fundraising is largely taken place by the largest private fund sponsors. I probably throw out Catterton, areas in that group. What's the general sentiment as the private capital, as everyone recognize that there's a narrative and it's playing out, that there's a consolidation within the private capital space? What's the general sentiment on fundraising? Is this is really kind of the rich gets richer, big gets bigger, and I'd be curious if this is the growing trend, because what's interesting is that having gone through the global financial crisis, kind of pre 2007, 2008, there was this realization that the mega funds were too big, and the fund sponsors or the investors post GFC, they started to focus more on the boutique and specialized funds. Do you guys anticipate that there might be a similar shift somewhere down the line, or we're really in the age of the big? This is really a game of the biggest funds.
Yeah, it's hard. I don't know, Stan. You could jump in because you guys are definitely larger than us. But I don't. It just, to me, it feels like that could play out, Albert. Right? It could. It just, I think a couple of things. One is, I think if you're specialized and you have and you kind of have good track record and you can show results, no matter, I think, the scale or at which you are, you're still going to be successful in some capacity. I do think that you as a large institution, though, need to diversify and grow, and I think we're going through that right now as well in terms of deploying new product, deploying even within within a segment. So even within private equity, there's multiple facets to where you can play within that, and so I think you can't just settle for where you are, even though you're a large manager. I do think you need to diversify within it internally. But I don't know if you're necessarily going to kind of just stop dead in your tracks and then that's it. And then all these new kind of up and coming boutique and bespoke type firms are going to be kind of popping up. I don't know what that looks like going forward. But I think that those are kind of the fundamentals that exist there.
Yeah, and I think maybe to add to that, I think at least for the time being, from my perspective, I think it's certainly not going to be a winner take all situation, right? I think there's going to sort of just need to be sort of different managers to go to, but I do believe that there's going to be sort of a continued consolidation to a certain respect, and I think that it's kind of a natural dynamic that's driven by probably 3, 4, 5 different factors that kind of allow larger managers to be more competitive, and so I would say the first one is, you think about LPs, and I think over the course of the past 5 to probably 10 years, I think LPs have also kind of taken a view that it's sort of easier or more efficient to sort of work with a handful of managers that have multiple different strategies that they can kind of plug and play and sort of be able to balance their allocations more efficiently and kind of have one point of contact effectively, to then be able to win and demand improvement on fees and structure and sort of structures with respect to their commitments. So I think there's, again, an economies of scale type of dynamic for investors. Then you take a look at the financing piece, which is hypercritical, I think, for any manager to be successful. that is the same story. I think if you talk to banks and certainly, I speak to banks, on a daily basis, and that's been the dynamic as well over the past probably decade, is that, larger institutions and quite frankly, smaller banks as well have kind of decided to narrow their scope of client coverage, if you will, and they'd rather go deeper with less clients to be able to, cross-sell ancillary business and so on. And so that again lends itself to a larger manager that's got, a larger wallet share and is able to kind of feed, the beasts there from that perspective. And then just the broader sort of economies scale element of just, operational efficiency and sort of, middle and back office type of operations. I think it allows, larger managers with sort of scale and sort of broad platforms to be, again, more efficient, deliver higher sort of returns and value to their investors. And so I think that dynamic doesn't really change, aside from the things that we don't know, Albert, is like, if there's a GFC and, if something, God forbid, sort of creates a dislocation, then things can change, right? And then either, whether a manager, again, goes away or regulation comes in, that type of, I think, situation could certainly, change the current trajectory and trends, but I don't necessarily see that sitting here today. Having said that, I don't think that, newer managers, while it's probably harder today to start something and sort of be, a mono or like a single sort of strategy type of fund. But there's always room for little guys. The beautiful thing about the US is there's always innovation. And so to the extent there's new asset classes that maybe larger managers aren't focused on, and, you think about things like AI and crypto and so on and so forth, there's going to be space for that. But ultimately, as that, I think, evolves and develops and gets more mature, then probably larger managers start noticing and kind of potentially, look to gobble that up. So that would be, my perspective on the nature of the consolidation.
Just really quick, an observation I have. I think during the financial crisis, right, of 7, 8, 9, coming out of that, you saw the hedge fund market really go towards the bigger getting bigger, right, as LPs consolidated, right? I think there's a period of time right now where the big are definitely getting the lion's share of allocated capital, right, for a lot of the reasons that Stan brought up. At the same time, I appreciate Frank's observation, right? If you have an angle, an investing expertise, there's always going to be room for you, right? There's always going to be people who say, wow, you're really good at this slice. I like that. You're giving outsized returns because you stick to your knitting and you're focused, right? We as an institution, right, we have on the order of $3.5 billion of investments across corporate PE, both large cap and mid-market managers. And we take the tact of just allocating on a diversified basis, right? Instead of saying we'll give Ares 500 million and Catterton 500 million and Blackstone 500 million, we're across 90 odd managers, right? Where we're smaller tickets across those GPs, right? To diversify it, but the team very much is focused on finding those managers who have a differentiated approach, certainly in the middle market, to invest in. Right. So I think there's still going to be this trend of the big continue to get bigger, right? That there's no way around that, but there's always going to be space for people who have an expertise in one specific area.
That's a good note. That's a good note for some of the more specialized boutique players. That's a good note to end on.
Yep.
Thanks, William. And Albert, in terms of bargaining power, what do you see currently between lenders and borrowers?
Interestingly, I think having been in the business and in the fund finance space for over 30 years, I always find that lenders in general always take a pretty commercial view working with fund sponsors. Granted, I think from a leverage bargaining perspective, economically, depending on kind of the economic cycle, certainly when the economic cycle is, as we come out of the regional banking crisis, GFC, certainly the lenders have an upper hand in terms of the pricing, and the pricing is what it is for the fund sponsors, if that's just the market dictating the terms. But overall, throughout the different cycles, what I realized just working on these transactions with our clients, in general, most lenders try to always do what's right for their client, and at the same time protecting the bank's interests, and always trying to find the optimal practical solution for their clients. So, so overall, I kind of view the leverage or bargaining position. I wouldn't necessarily say that the private equity funds have the advantage in the sense that they always get what they ask for. But in general, I think there is a balance that I think the fund sponsor would also recognize that the lenders have certain points that they have to have, and I find in general there is a balance and a dance. And I think the leverage point that, Michael, that you're alluding to, I think it relates to more of, as you're coming out of different economic cycles, it might change in the sense of what the economic perspective may be on the structuring of the facility. You might get a little bit more conservative on the covenants and the reps, but overall, I still see, even in some circumstances where you would say, gosh, we're in this economic cycle that coming out of the regional financial crisis, sure, all the lenders should be even more critical with respect to their covenants and reps. But I overall, I still see lenders being very practical about it. So right now, I think we're at a place where it's a nice balance of kind of the working relationship between the lenders and the borrower, and I think a little bit in favor of the borrower, if you want to talk about kind of who has the current leverage. I think we touched upon it at the beginning of this panel. In terms of what Frank and Stan have mentioned in terms of kind of what they're able to push for right now, certainly in terms of economics.
Thank you, Albert. William, from your side, what do you think?
Yeah, I think it's certainly the pendulum has come back to being a borrower-friendly market, right? We touched on it a couple points in time during the call. The margins are coming down. There's more liquidity. I think what really changes things for me, right? And in my role as the head of origination, it's really the senior client officer, right? So many conversations are wonderful and warm and fuzzy, and many conversations are uncomfortable, right? But what I think is important, and where we as an institution like to lean into relationships, is when it's not just about grinding down every last basis point or every single structural feature. When both institutions trust one another to execute, to rely on one another when times get tough down the line, and have an honest conversation about it, something difficult, and find a solution instead of someone just putting up a wall and saying, sorry, tough luck, go read the credit agreement, this is what it says, right? That's where we love to bring the proverbial dump truck and just unload capital, because those are real relationships, right? And that's what's important. And I have a lot of those types of relationships, and I have a lot of relationships that like to grind every single basis point to the end, right? You can't operate a business without both. But what I enjoy is the former, because I think for all parties involved, if you're talking about, 5 basis points on $100 million, that's not moving anyone's needle either direction, right? It's not making us meet our budget, and it's certainly not impacting the returns, even if you're talking about a revolver fund strategy on a credit business, right? There's always still enough return to go around for everybody. So I think that's always the dance that you have to find, a healthy balance. And while yes, it is a borrower-friendly market, you want to make sure that both interests are aligned to go forward.
Thank you, William. And Rossella, from your side.
So I agree really with what William just said, and for sure it's becoming a more borrower-friendly bargain, but you look at the relationship at 360 degrees, and really what we try to do is look at the relationship across all levels, so how we can service a sponsor from the advisory side, from the banking side, from the cash management side. We also look at how we can be a client of the sponsor. We have a big retail network in Italy, in Germany. Can we distribute units of that sponsor into this region? Here it's UniCredit who is the client. So we really look at the relationship from an overall perspective.
Thank you very much, Rossella. And Stan, from your side, in terms of private credit and secondary funds, which trends are you seeing?
Sorry, it took me a second there to get the mute off. Yeah, so I think maybe touching on the secondary side, and as I mentioned a little bit earlier in this conversation, I think that remains a large focus area for the market, quite frankly, as that's I've probably beaten this word to death now. Further innovation in the space is sort of allows for liquidity around historically illiquid LP stakes for investors, equally for GPs as well. And so I think we're going to continue to see growth in the space across all the different types of asset class type of managers. I think private credit secondaries, as I said, that's been a focus area for us and a growth area that is, I think, still relatively early and maybe newer than maybe the private equity secondaries and real estate secondaries side of things. And so that's going to continue to be a growth area, across the market with more transactions. I think last year was a pretty active year with respect to that credit secondaries side of things, and I think this year is expected to probably be larger than that as well, just from a transactions perspective. On the private credit side, sort of primary, I think that continues to be a growth area across the market, and as LPs continue to educate themselves on that, as retail comes into that space, I think that continues to grow, and the partnerships or sort of the continued disintermediation of the banks, however you kind of want to think about it, I think that will sort of continue to be important for that market to sort of be able to deploy and grow as well. Within that, though, I think private credit is expanding, and this is no secret, into not just sort of corporate and middle market sort of lending, but also into sort of asset-backed finance, which is a significant growth area for us, our alternative credit business, which is effectively everything kind of non-corporate. So you think kind of consumer, retail, private ABS, fund finance as well, which is impacting the market we're talking about, but also I think a massively sort of untapped private capital market, if you kind of think about just the scope and the scale of those types of assets, with respect to what banks are doing. So I think that all continues to grow. I think that's not a new trend for 25, but I could see it being further accelerated just as the education process continues and starts kind of showing its effects.
Stan, help me understand the credit secondary space a little bit more. I'm just not as keyed into it. Is the growth potential there from a fundraising and a deployment perspective largely based around the fact that the private credit market over the past, 11 years at this point has just exploded, right? So you've got LPs who are looking to transition out of their portfolio, maybe deploy it into other managers, and recycle that? Or is there something larger at play that I'm just not really understanding?
Yeah, no, I think that's a good question. So I think, when it's sort of, at least from my understanding and sort of from when I started sort of following that market, over, still relatively recently, I think past few years, I think there was probably some larger discounts to be had on those types of, portfolio acquisitions, again, driven by the 23 dislocation. And even before that, just the fact that with sort of, I mean, maybe even in 22, the public equity market sell off. And so LPs, sort of got caught a little bit off sides with their private capital allocation. So things like that. I think today, in a as we've been all saying, sort of a healthier credit market broadly, I think we're seeing the discounts to those types of portfolios kind of being eroded, to be frank. And so those are kind of trading probably more at par than they were just a couple of years ago. But having said that, I think it's still an important sort of element to the market and a need in the liquidity sense, like you said, William, is LPs just looking to either rotate out or for whatever reason are needing liquidity. Obviously these types of funds are not, the private equity where there's a sort of long tail element to maybe, if markets are closed, there's not a clear, exit path or liquidity path. But with credit, it tends to be, pretty straightforward with kind of maturities and refinances along the way. Again, if markets close up and refinancing gets more challenging, then this is a great sort of tool to have in the toolkit for investors. But even if, say, markets are fine, again, I think the liquidity element is what's important and what's helpful. And so, from my understanding, that's kind of the driver of the development of this kind of asset class.
Super helpful.
Thank you, Stan. And more generally, what are the advantages of private credit in fund finance?
Sorry, what was the question, and to who?
Yeah, actually, from your side, what are the advantages of private credit in terms of fund finance? What they can bring actually to the market?
Right. So more from a lending perspective or from a borrower?
Indeed, from a lender's perspective, yeah, indeed.
Yeah. So, well, I guess, again, with sort of the alternative credit side of things and private credit expanding to fund finance effectively, I think what is interesting and what they could bring is, unlike banks, I think there's inherently the ability to sort of take on a bit more risk and be a little bit more flexible and thoughtful around structures. And this is not a dig at William or Rossella. I think, I know generally the folks around this conversation are quite innovative and flexible, but broadly speaking, it's just a different sort of, regulatory regime. It's a different sort of structure of capital. So I think ultimately, that is that sort of solutions oriented mindset that comes with, private capital into the space. Having said that, and sort of piggybacking off of what William said earlier, is the real question and sort of the real nut to crack. And I don't really know that gets cracked this year. I agree, is sort of the revolving nature of these types of solutions, which doesn't really, is not really efficient for really, anyone aside from banks, just based on the setup of operations and sort of funding structures and so on. And so I think while the risk profile and sort of the structural expertise and more structured type of products and offerings that can come from the private markets are super important, helpful, and kind of relieve and quite frankly add to the supply in the whole market. But at the same time, there's always going to be the bank element, at least either as a partnership with private lenders or, on their own, to sort of to provide sort of the revolving, needs of managers.
Thanks, Dan. And from your side, what are your views?
Yeah, I think private capital coming into this space is huge, and I think is very helpful from a borrower perspective. I think the one thing that we always have to, William mentioned it earlier, the difference in 5 basis points is not material to us when it comes to, the relationship. However, private capital costs the capital in comparison to bank cost of capital is probably a little bit wider. So there is more of a view of that comparison of how much are we willing to pay for the flexibility and for the things that Stan highlights, because I do think there's a lot of value add for that. It's just weighing the pros and cons around costs and such that I think is key for it. So all in all, I'm a huge supporter of it, and I think there's a huge need for it, especially for us. I know we speak to a lot of those parties, especially around NAV and preferred as well, because I think there's a lot of flexibility built into there that they can do, not just within sublines. So I think all of those pieces are important when thinking about where the capital is coming from and what party to use.
Thank you very much, Frank. And William, in terms of ESG and fund finance, I'll be curious to know if you have seen a lot of transactions in 2024 and what you expect for 2025.
We had, I want to say there was probably a very, very big drive towards ESG a few years ago. Certainly domestically, right? I appreciate Rossella's going to have a differing opinion because it was prevalent in Europe for many, many years before that. But there was certainly a drive domestically here in the US for more transactions, which has, I don't want to say dried up entirely because it certainly hasn't, but it's just become less of a focus for GPs raising new strategies. And maybe it's just, maybe the subtlety is around they have their strategy, they've raised funds, and that fund is just investing, right? So it's going to be 3-4 years before they need to put a new fund in place. And maybe we're just in this lull period in between. But there certainly hasn't been as many requests as there were a few years ago when there was just a real flurry of them. I think GPs largely have understood the rules that they need to play by in order to benefit and hit their KPIs, to see a reduction in margins based on the use of proceeds. But there's certainly been a lull, at least from my perspective. I'm curious, Albert, you obviously see a monster swath of the market. And Rossella, I'm curious if it's still as prevalent in Europe.
So I guess from my
Go ahead, Rossella, please.
So I guess from my perspective, in terms of the volumes of transaction that we saw with an ESG feature, I would say approximately 20% of the overall volume, maybe slightly below that, but let's say between 10 and 20% of the transactions we have seen were had an ESG feature. What is probably more relevant is that from a bank perspective, we do scrutinize a lot what is the ESG policy of the fund to make sure that it's compliant with our framework and our internal policy. That doesn't mean that the facility per se would have an ESG toggle in terms of spread, which as you say, has spread up a lot.
Yeah, so this is an interesting topic question, Michael. I remember a few years ago sitting at the FFA Asia Symposium, and it was around the time of there were more proliferation of the sustainability financing and ESG, but there was also domestically within the United States there were already certain states that I think people call it the red states or more conservative states, who felt that it gone a little bit too far and they started to push back on some of these initiatives. And I remember it was a bit, when I raised that at the panel, it was viewed as a bit of a controversial comment that how could these certain states be pushing back against kind of what it should be a generally good for the overall market and kind of on a more high level basis, and kind of where we're at now, several years later, I think that has certainly tempered as in terms of the whole ESG facility, sustainability facility. While we still see some lenders still do the sustainability facility financing, I think some of these lenders also behind the scene feel like it's really just a means for more competitive pricing for the fund sponsor, so it's, looking at our deal tracker from last year, it certainly has curtailed quite a bit. That being said, the ILPA, the Institutional Limited Partner Association, they do have a new guideline about ESG financing. So does LSTA. They have model form. So it's I think it's there, and but presently it is certainly not as prevalent as what we've seen several years back, when it was certainly the flavor of for topic for many people.
Thanks very much, Albert. And Frank, a more general question. I would be interested to know from your side the utility of fund financing from a borrower perspective, and what is the general sentiment of the LPs vis-a-vis fund finance?
Yeah, I think LPs are overall supportive of the use of these. I think transparency is always just key in their eyes. As long as they're aware and seeing what's happening and have a good understanding as to the rationale and the use of any sort of fund finance facility, I don't think we've ever had really a lot of noise or pushback from certain things in those instances, right? So I think as long as, and I think that's just a trend across all of this, right? I think as long as there's transparency and communication between banks and borrowers, right? I think that is going to be the key driver for all of it, and I think that also translates to the LP sentiment as well.
Thank you very much, Frank. And Stan, from your side, what are your views?
With respect to sort of LP sentiment and fund finance broadly? Yeah, no, look, I think I agree with Frank. Generally, if you kind of maybe bifurcate fund finance between sort of subscription facilities and maybe NAV facilities, the subscription side of things, we've kind of seen that evolution now over, decade plus, with respect to sort of LPs initially not sort of fully appreciating just, kind of exactly these structures and what they're meant to accomplish. And then sort of an education process that then ultimately now I think LPs are really well, informed on these types of products. And frankly, from my personal experience, I think, are kind of, welcome the value that they bring, whether it be smoothing out capital calls or making things more efficient, or providing some sort of light leverage effectively to returns, as long as it's properly being recorded and reported effectively to LPs, so they could sort of make their decisions. I think on the NAV side of things, we're sort of seeing this in the past couple of years play out in a similar fashion to sort of the way sublines had played out, where, at first it's kind of like, what is this? And then, kind of what does it actually mean for the risk or any sort of perceived additional risk that funds might be taking on. But at the same time, as folks get educated, I believe that's going to continue to be an important product and a growth area for the fund finance space generally, that will be embraced by LPs in specific situations, right? I think every kind of NAV opportunity is unique in itself, and the use cases are unique, and so for the right ones, that's going to continue to proliferate.
Thank you very much, Stan. And as a final word and wishes for industry for 2025, Stan, what would be your words?
So as the final for, what was that?
I would say, what would be your final word for the event and your wishes for the industry for 2025?
Well, yeah, no, I mean, I think similarly to what's been said here today, and I think just folks broadly in our market, I'm optimistic and looking forward to another strong year. Hopefully without too many disruptions. But wish everyone luck and a strong 25.
Thank you, Stan. And Rossella, from your side, what are your final words?
Same from my side. I wish everyone a very successful year, a very good fundraising for our sponsor GPs, and I hope to see you all in Miami. Please grab me if you see me.
Thank you, Rossella. And William, from your side.
Yeah, I think I'd go back to the theme of innovation, right? And we've touched on it today, right? But thinking about different structures, is it a single asset back leverage deal? Is it a subscription acquisition financing? Or is it these democratization vehicles and the NAV associated with that, right? We see more unregulated investment vehicles with a regulated fund wrapper, right? Even going down concentrated LP bases or SMAs, right? Anything to kind of get away from just the regular way business that we've been doing for so long, I think is certainly something that I'd really love to entertain more this year and hope the market does, even if lenders are just dipping their toes into it and getting the first deal done. Appreciate these things take a while with internal approvals at our institutions, and it's never that easy, but that's my hope, right? And then get some sunshine and no rain down in Miami.
Thank you, William. And Frank, from your side.
Yeah, no, I think I just echo what everybody's saying in regards to weather. No, but in regards to everything on fund finance, I really do think it's an evolving market. I think things that have been around for a while are there, and we know that they're not going anywhere. But I think the innovation that William talks about, I think the creative thinking that a number of the folks on this panel have discussed are going to be the key drivers going into the future for us. So I'm excited of what's to come. I think from my perspective, it's always going to be relationship driven in all of this. As long as you have a strong relationship with all parties, you can get through anything and really come to good resolution. So I'll always push that with whoever I speak with and our teams to whoever they speak with. So excited for the year to come and excited to see you all hopefully in a few weeks and really look forward to kind of continuing this product into the future.
Thank you, Frank. Albert, you have the last word.
All right. Well, so we just published our 2024 annual report on fund finance. And within the report, we have a survey from we have over, several hundred participants who responded to our survey. So over 80% of the survey respondents feel that 2025 is going to increase in activity in fund finance. And the general sentiment from the lenders are that comparing to 2024, almost 90% feel like it's going to be a better fundraising environment for the funds and much more favorable exit. Over 70% feel there's very favorable exit environment for the fund sponsors. So all positive sentiments from many of the fund finance participants. I guess the last thing I'll say is that the fund finance market is dynamic, on a global basis, and we think that it will continue to expand, not in terms of also in North America, Europe, as well as Asia. And I think one of the interesting thing will be, as many of you have touched upon, is that I think beyond the traditional subscription financing and also the growth in NAV financing, I think we will also see more lenders offering more debt capital solutions going forward. So very dynamic market, so exciting times.
Yeah, Albert, I think one of the things, and appreciate that report came out yesterday. It's a really good read for information on the subscription space, on the NAV space. Obviously, there's a section near the end for the outlook of next year. It's interesting to see some of the subtleties around the responses, because some of them go against what I think personally I've seen from our own portfolio. So it's really a good snapshot of what the market is thinking, where they're anticipating it going. So appreciate you guys putting that together, and I hope everybody has a chance to read it, because it's got a lot of good stuff in there.
Thank you, William.
Yeah.
I echo that. I got to read it last night, and very, very helpful.
Yeah.
Thank you. So thank you
Yep.
to all our speakers today. Thank you for your insights.
Thank you,
to the
Michael.
audience
Thanks,
as well
Michael.
for your time,
Thanks.
and so stay tuned for our next Fund Finance very soon. Bye bye. Cheers.
Bye-bye.
Thank you, Michael.